Apologies, I'm a little bit late. Just had to sort a few things out before actually coming live. Thank you for joining me. The last time we did this was, I think, a couple of weeks ago. Was it a couple of weeks or last week? I can't remember. It was a couple of weeks ago, I think. Anyway, we were on here for like an hour 45. I don't quite want to be on for that long this time round, but we'll give this a good go in terms of trying to get some interaction and some questions actually going. So, as always, what I'm going to do is I'm going to put maybe 45 minutes on the clock here. Bearing in mind, I came on late, so give it maybe till 10 to answer as many questions as I can from you guys who obviously are here watching live and follow the channel quite a bit. Yeah, so look, as usual, put your questions in the comments. Please do type a 1 if you can hear me, because last time I tried to do this, I had issues with audio, even though I have checked it. So if you can put a 1, let me know that you can hear me. That'll be amazing. And we can get cracking with some questions. Perfect. Thanks, Ursula. Thank you. All right. Jamie, let's jump in with Jamie right here straight away. Is there going to be a house price crash? If so, by how much? Will interest rates keep going up? I don't know, mate. Whether the house prices will crash or not is anyone's guess at the end of the day. If anyone tells you that they know, they're going to be lying. I think the only thing you can do is try and follow what is happening currently. So even though interest rates are continuing to go up, and I think they will continue to go up. Oh, 1 second. Let's come back to this one in a moment. Even though interest rates will continue to go up, I believe, I think the bank rate is going to plateau at some point. So the forecast for the Bank of England base rate was, I think, was just over 5% earlier in January. That's been revised down now. So the forecast for the Bank of England is a lot lower. So the consensus of the forecast is that what we'll find is that we'll see another 0.25% increase next month. So that will take it to 4.25. And then depending what happens with the inflation numbers, we might see the bank rate either be paused, held off, so there's no more increases. But I don't see that bank rate going down until we get inflation down into the target territory of 2%. And there is a long way to go for that to happen. Now, in regards to mortgage rates, I covered on the channel yesterday that the mortgage rates are falling, and that's because a lot of the lenders they're creating lending mechanisms. So they're not putting up rates, but what they are doing is they are putting up their product fees on mortgages now. So the product fees that you'll find in mortgages at the moment are, circa £2,000, whereas before you had either none or they were just like 400-500 quid. So they're compensating essentially. They know that it's costing them more money to hold the money on the books to borrow, and interest rates or mortgage rates going up is going to dissuade people from buying properties, and they need to lend that money out. So what they're doing is they're keeping the rates low, but they're increasing product fees. And I think we will probably see similar moving forward. But in terms of the house prices crashing, it really depends, mate. Unemployment numbers are going to come into this. Mortgage rates are going to come into this as well, because we still have a supply versus demand issue where we've got too many people for the supply of houses that we have. And so for there to be a significant drop, in my view, and I'm not a property expert, I think that would be a byproduct of interest rates rising around mortgages specifically. But what we're seeing over the past couple of months is mortgage rates are being kept pretty low, and that's going to go some way to propping up the property market, if that makes any sense. So that's just a few thoughts. All right, let's get to this one. Why do most lenders only allow you to overpay a mortgage by 10% of the borrowed amount on an annual basis? With this silly rule in place, how can you make yourself mortgage free in under 2 or 3 years? Okay, well, look, let's be completely honest, mate. The lenders don't have any interest in you being mortgage free. That's just the simple fact of the matter. Okay, so you got to think about it from a lender's point of view. So if someone came to you and said, right, give me 100 grand, and I'll pay you back this 100 grand over the next 10 years. If this person then says out of the blue, I'm going to pay you back in 2, 3 years. Bearing in mind the interest rate that you set for that 100 grand, you would have calculated how much profit you're going to make as a business that needs to employ people and keep people in jobs, right? Now, if someone says, I'm going to pay it off in 2, 3 years and there are no penalties whatsoever, your business model automatically goes out the window. It's the same thing with the lenders. They don't care about you being mortgage free. That's not their problem at all. So the 10% is there because it's an allowance for you to overpay without any penalties. You can pay more, but you've got to pay a penalty because if you pay it down quicker, guess what? The profit that they are going to make is going to be reduced. It's simple business practice at the end of the day. It is very unpalatable, and I completely get where you're going, but it's not your lender's priority for you to be mortgage free. That's your priority as a business. They don't really care too much about that. What they're concerned about is, first and foremost, how does them lending you money, considering they're taking a default risk with that? Yes, you might not pay it back. Yes, they might be able to reclaim the property 100%, but that's still a business risk to them. So they're more concerned about the business risk that they carry, which is why the interest rates are set the way they are, based on loan to value, credit score, all this kind of stuff, right? But yeah, they don't necessarily care for you to be mortgage free because, well, it's money that they're not going to be lending out. They're not going to be earning interest on. So the 10% rule is just there because it allows you a buffer. You can pay over, but you've got to pay a fee. There are some lenders. So when I was advising on mortgages, there were certain lenders that would allow you to pay a little bit more. I think the most that I've seen is 20%. They were very, very rare. And this was going back to 2018, 19. I think 20% was the highest that I saw. And, when you're talking about overpaying your mortgage, it's also worthwhile noting that, and the rule has changed, or the rule of thumb has changed quite a bit. Sometimes it's 10% of your original balance, so your original mortgage, and sometimes it's 10% of your outstanding balance. I think most of the lenders have come to the latter, so they'll allow you to overpay 10% of your outstanding balance, in opposed to your original balance. Because if you think about it, if you started off with a mortgage of £250,000, that means that every year you could pay off 25 grand, even though you might only owe 150, for example, on your mortgage. So there has been a lot of movement in that space over the last, 4, 5, 6 years or so. But yeah, mate, I know that it may sound annoying, but the banks are talking about profit at the end of the day, and that's what they're thinking about. Yeah, I like this. I like this. Yes. Hey, listen, man. As a United fan, and I'm sure you'll agree, mate. I'm doing well, by the way. Thanks for asking. I'm sure you'll agree that it's nice to see the team actually winning matches. I didn't get to see the full Leicester match. I've got to try and catch it on Match of the Day, just the highlights. But I've seen bits and pieces. But man, Rashford, oh my god. Oh, that guy's been an absolute godsend. And who would have thought? Who would have thought Ronaldo leaving would be in this position? It's a great place to be. It's a really, really nice place to be, and it's nice to see the team doing well. And yeah, we've got a final at some point. Is it this week? This weekend? We got Barcelona. I mean, the match against Barcelona was unreal. Just oh my god! Like, it's nice to see the team doing well. And not to wind up my mate who supports Liverpool, but hey, look how times have changed, huh? That's what they were saying about us. Let's carry on. But it just shows Ten Hag is doing an amazing job, and I think, you know all the power to him. May continue, because look, we're further ahead than we thought we were going to be this time in the cycle. 6 months in, and look where we are, third in the league. We're not going to win, but we're still in contention. We'll see what happens, mate. Keep winning matches, and then we got the possible takeover as well. It's exciting times. Exciting times. Anyway. Would you suggest someone who was a cash buyer to start looking for a house now? Yes. I mean, look, there's nothing wrong with you. One second. One second. One second. There is nothing wrong with looking to see what the market is saying, especially if you're a cash buyer. If you're a cash buyer, you could probably go in and negotiate a discount on house prices. Look, I think from the numbers that we've seen over the past couple of weeks, I think the housing market is probably house prices have come down by about 10% or so. So if you're a cash buyer, no chain, then that potentially means that you could, if you're going for a place of 250, you could probably go in with an offer of 230 and see what happens. Being a cash buyer gives you leverage, quick closure. So yeah, keep looking. I mean, the question is, do you think house prices are going to fall any further? Like I've already said, we don't know. So I don't think there's any harm in waiting. Will property prices recover overnight? No, I don't think they will. So you may decide to bide your time, but how are you going to know if you don't pay attention or keep an eye on the market? And I think that would be my advice, really. Keep an eye on the market and make a move that you feel is going to work best for you. Right. Is Tesla going up more? You know what? I've not paid attention to Tesla at all. I did have a look at my account where I hold some of my Tesla, and it is up, but I've not paid any huge amount of attention to it. It has had a big run up though, to be fair, which has been welcome, which has been really, really welcome considering where we have been. But let me just have a look right now. Where are we? Tesla. Um, I'm just going to have a look at the chart. Yeah, it's done all right. It's done all right. Maybe I need to do a video on that. I did do a video. The last video I did on Tesla was kind of just having a look at just a basic analysis over where they are right now. Well, where they were at that point when obviously the prices were down. It was undervalued for the first time in a good number of years. And I don't know, this is where investing becomes very, very interesting, right? And where it's very much a psychological game, because people were freaking out that Tesla it's lost its value and all this stuff. And it's like, for the longest time, people were complaining that Tesla was overvalued. So now it's undervalued, and everyone's saying you should run for the hills and just dump the stock and you need to get out and all this kind of stuff. And I'm like, when it was overvalued, people were complaining. Now it's undervalued, people are complaining. Like, you start to question where the logic behind the comments actually come from. And if you really have done the research around what they're doing as a company, then surely it being undervalued is potentially a buy signal for you, because you're like, okay, if you still believe in what the company is doing, you still believe in the growth of the business. And let's not forget, they are the only, let me just say this, the only car company that is growing. All the other car companies are not growing. They're the only ones that are growing by a considerable margin. Why would you not be buying more? Like, surely, like, your conviction would have been confirmed in the midst of what people are calling will be a recession. The company's still growing. The company is still delivered, although it missed its targets very, very marginally. It's a really, really big. You have to start thinking why people say the things they do and the reasons behind their comments. And that for me is always very, very interesting to go and find those answers. And you take those answers, you compare it with what you feel is right based on your knowledge and your understanding and your, I guess, your belief in the company, and you contrast them. And if they have a point, you take that on board. If they don't, then you pretty much disregard it. But very, very interesting. I need to do another video on Tesla specifically, but yeah, I think my position still hasn't changed on the business. I think they're still going to do really, really well. Oh yeah, look, I've just seen someone here just mention, and let me just have a look at these numbers. Okay, look, so there's almost 50 of us on here. There are only 6 likes on the video, so I give up my time in the evenings on a Sunday just to do this ever so often. But it'd be great if you can actually smash the like button, get those numbers up. There's, almost 50 of us. Let's get that up to 20. That would be amazing. The reason why that is important is because from a interaction point of view, likes and comments and general interaction, watching it all the way through gives the YouTube algorithm a signal that the content is good and people interact with it. And it basically means that other people will get to see it as well. And it just helps the channel grow. Oh, and can I just say, by the way, thank you for 40,000 subs. We crossed 40,000 subs. I think it was the day before yesterday. And I'm not going to lie, it's been a slog to get to 40,000. Not that the number's really, really important, but it's nice to see the number actually grow. So thank you, everyone. And welcome to anyone who's actually new, who may be watching this either live or on replay as well. Let's have a look and see what else we have in terms of questions here. Andy, how you doing? All right, let's have a look at this. One, great to see you live. How was your week? Anything we need to look out for in terms of financial news for the next weeks? By the way, my friend liked the video on house prices. Keep up the great work. Thank you, mate. Look, Naeem, I'm good, first and foremost. The week was challenging to say the least. I've not really felt myself, if I'm completely honest. I've not felt myself now for probably about a week and a bit. So I've struggled a bit, and that's been hard to kind of like balance out. I'm tired. I've not had a proper time off for almost, it feels like a year now, just over a year. The last time that I had off was Christmas, 21, 22. So I've been flat out ever since, and that's kind of, yeah, it's kind of got to me at the moment where I'm just feeling a little under the weather, tired, and just very flat. I'm generally quite good at powering through work, and I'm generally quite motivated a lot of the time. Just haven't been over the past week, procrastinating, and there's been a lot that's going on. But yeah, other than that, it's all good. I know that I need to book a holiday, and I will be looking to do that, but I can't do that now until April because I'm just chock a block, and there's a lot of stuff happening between now and April. Obviously, the book comes out on March 16th, so that's a little under a month now. So in April, I'll look to take some time off and maybe get out of the country and just do a little bit of traveling. Um, Anything on the financial news over the next week? Let me have a look very quickly and see what we've actually got coming out. I think the US has got some news, but then mainly looking at some consumer protections. And I don't know if you've noticed that I don't really cover the US market specifically. I think there are a lot of YouTube channels that are UK based that cover the UK market, the US markets. And yes, it does impact us for sure. But for me, I'd rather focus on the UK um, issue itself. So I don't think we have any marked dates. Let me just have a look. One second. I might share this with you as well because you can use this resource if I can just find it, and it will keep you up with all of the happenings, any interesting dates. Where was it? Um, where was it? Which one was I using? Which one was I using? I can't remember which one I was using now. It actually gives you actually let me just try this one second. It will give you a list of things coming up during the week for different markets. So if you're looking at the US market, the UK market, maybe you're looking at Germany, for example, it also gives you highlights on that as well. I can't find it. I can't remember which one I was using now. Thought I had it in my tabs, but it's not on here. What I'll do is if I find it, I'll put a link to it so you guys can use it, but it will give you an idea of what's going on. I've not really tracked much over the past week or so. Like I said, I mean, I think in times like this, because of the way my portfolio is shaped, it's pretty much shaped full of index funds, ETFs, and I've got some individual stock picks in there. The stock picks that I have, I'm relatively comfortable with. So some of them, actually, there's two of them that I do need to offload because they're just not coming back at the end of the day. And from a behavioral psychology point of view, holding on to it makes no sense whatsoever. So I need to get rid of those. But the rest of them, I'm pretty happy with. They're pretty established businesses. And so I'm not going to be touching any of those. And then the index funds and the ETFs that I have, I'm pretty happy with. So I'm not touching those either. And actually, the S&P 500 from my entry point has actually done extremely well. I was looking at this the other day. My portfolio on the S&P 500, right? Actually, let me just have a look at it right now. The other day, so bearing in mind, it has been down like 10%. And it was down 10% for a good number of months when things were really, really volatile. If I log into my Vanguard account right now, I was looking at this the other day, and I think I was like one point something down. Yeah, so I'm 1.74 down at the moment in the S&P 500, which means that we've actually seen good growth in the S&P 500. And I think this is really, really important because there's a lot of news out there that will spook people, right? That will make people think, well, actually, maybe I need to get out of my position. Maybe I need to close it altogether and just revise my investment portfolio. It's really, really important to hold your nerves because if if I had decided to cash in this investment when it was 10% down, right? I would have lost just about £1,000 roughly, right? Because I've got 10 grand in there, right? I would have crystallized a loss and forgotten about why I bought the S&P 500 in the first place. And I think it's really, really important, especially in market cycles where things are going up, things will go down. It comes with the territory. And unfortunately, a lot of people have been lied to saying that, with the under the assumption that the markets will always be positive. No, they're not. They are cyclical. So as you go up, things are also going to come down. The gift of any investor is to hold your nerve and to understand what's happening in the background. And when you understand what's happening in the background, you then use that as I guess, a mechanism really to try and help you understand what your next move is going to be. So for me, yes, I might be 1.74 down, but actually what I'm looking at here is I'm seeing a recovery. And I'm seeing a recovery in a position where actually if things start to go well with the US inflation numbers, and we think that their inflation numbers have actually, let's have a look at their inflation numbers actually. I'll share my screen. Let's have a look at their inflation numbers right now because their inflation numbers are a lot better than ours. Um, and inflation. Let's have a look at the United States. Let me just grab them 1 second, and I'll share this screen. 1 second. Which one are we on? We are on. No, not that one. This one. Okay. Oh, my mouse. Sometimes it is so frustrating. And I've got a Logitech mouse and keyboard as well, and it's just very, very pedantic. It's got a mind of its own, I swear. Sometimes the button will click, it will work, sometimes it won't. And right now, it's just deciding that it doesn't want to work. Actually, let's see if we can do this. It is utterly ridiculous. Um, can we click this? All right, we'll click that one. So what's going on here? Let's move that. There we go. Okay, fingers crossed. All right, here we go. So this was the US inflation numbers. Okay, so look, this is really, really important. So look at their inflation journey, right? So this is probably what, June 9.1. They've seen a steady decline in their inflation number to the point they're at 6.9, 6.4% right now. Now, clearly, they have different inflation pressures to us. I mean, their situation is very, very different to ours, and we have to acknowledge that. And generally speaking, when you see the Fed put up the interest rates, we typically tend to follow suit. And I think it is you can assume that the Bank of England will do exactly the same, because let's actually have a look at their interest rates, import prices. We need to have a look at another chart here. Let's go forecast. Let's go United States here, and let's have a look at their interest rate. So, I mean, look, their interest rate is still forecast to be at 5.25 by the end of this year, but actually, their journey to 4.75 has been quite tapered, right? So what we've seen increases. They've kind of done it more methodically, but their numbers are very, very different to ours in terms of the pressure that they actually have. To get their inflation down to 6.4% has been very, very impressive. We are still at 10.1%, down from 10.5 last month. So a 0.04% decrease in inflation. And so these numbers are really, really important when it comes to the States, because this will dictate what the Fed are going to do next. And I fully expect that they will probably ease off their interest rate hikes fairly shortly, because you cannot deny from their peak of 9.1 to get it down to 6.4, they've been really, really aggressive. And that is going to have a massive impact on their economic outlook and so on and so forth. And I think we will see a bit of an impact there. But going back to the S&P 500, the reason why the S&P 500 has surged back is partly to do with this. Partly to do with this right here, that trajectory of inflation coming back here. So I think, when you're looking at investments, it's really important to understand the full picture and not just taking information from the internet in silos that you can't necessarily make sense of. And this is why it's always great for you to look at different channels, get different pieces of information, opinions from different people, and try and formulate your own opinion of what you think is happening and how that translates to your investment portfolio. It's really, really important. And asking questions are also very important too. Let's have a look at this one right here. Thank you so much for watching. But any quick tips on how to start? I'm totally new. Going through Revolution in my head, it can save £500 a month. Auto ISAs. I'm medium risk. What platform? Okay, so if you want to go for a platform, there's probably a number of them. I mean, look, you can go Vanguard, but if you need to understand what you're doing. So I've got money in Vanguard. They're great. They're low cost, but you kind of need to understand what you're picking. So again, diversification is key. So I've just talked about the S&P 500 there. They are international numbers, but international companies, but they are US based companies. So geographical diversification is going to be an issue. Across different industries and sectors, you'll be fine. But I think if you're a complete and utter newbie, you need to be thinking globally. You need to be thinking about getting exposure to the UK, to Europe, to America, to China, emerging markets. You need to be thinking more globally, because that will spread your risk and help you sleep a little bit better at night. So I think Vanguard is great. You can look at the VWRL potentially as an option if you want to pick it yourself and you want to obviously monitor it and do all that management on your own, because you're going to have to review it every single year. If that isn't you, then probably um, Wealthify, Nutmeg maybe. Um, I'm just trying to think of the ones that I know of that I've kind of used that are good. Those would be the three. But with those guys, you're giving them the money. They will manage it for you. You don't have to do anything apart from set up a standing order. The caveat here is you're paying significantly more than you would be paying if you use someone like Vanguard. An alternative to Vanguard will be Invest Engine. They are relatively new, but you can get the Vanguard ETFs and index funds cheaper than you can with Vanguard. That's because with Invest Engine, you're not paying the Vanguard platform fee or account fee. So it will be marginally cheaper if you went through someone like Invest Engine. So go check those out as just options to have a look at. But yeah, the fact that you're starting out, you've got £500 a month, you're looking into putting that into an ISA, that's great. You want to be able to utilize your full £20,000 allowance before you won't be able to do that before the end of the tax year if you're saving monthly, but you'll get to use all of your allowance. The only other thing that I would say that you need to be mindful of is, how long are you looking to invest for? If you're looking to put the money in for 2-3 years, mate, I wouldn't even bother. You don't have enough time. Imagine the markets, we go into a recession, in the next quarter or so, the markets crash. We could be in a recession for the next 2-3 years if that were to happen. And if you needed your money out at that point, you just wouldn't be able to get your money out without potentially taking a loss. So that will be the first thing to make sure you're really, really clear on how long you're looking to invest for. Typically, you need 5 years as a minimum term before you start looking at the markets. But other than that, I think you'll be on you've got the right idea. £500 a month into an ISA, that's pretty good. Recommendations for best websites to research stocks and stock market. So you can use investing.com is good. You need to understand what you're looking at though, because so this is right. Let's just back up a little bit. Researching stocks, right? So, for example, if you want to buy Tesla, researching Tesla as a company, you're going to get a lot of information on websites. So you can use Yahoo Finance, but do you know what you're looking for? So, for example, on Yahoo Finance, let me just go onto it really quickly now. Um, Let me just type in find Tesla, for example, right? Let's share this with you. All right. So this is Yahoo Finance. This is Tesla on Yahoo Finance. All right. So this gives you a lot of information. So it will give you financials, right? So you've got all of the financials here. So within this, you're going to have their income statement, their balance sheet. You're going to have their cash flow as well. This is a ton of numbers. The question is, do you understand what all of these numbers basically mean? So, for example, right, if you start going into their income statement, for example, this is their total revenue. What are the trends that you're actually looking for? Now, when I look at this, right, I'm looking at the trend of, okay, so in 2019, this is how much their total revenue was. I'm looking for a growth trajectory on their total revenue. And as you can see in the case of Tesla, we're going from what? This is 24 billion to 31 billion, 53 billion, 81 billion, right? Massive, massive growth in revenue. But actually, what does cost of revenue mean? You need to understand that, right? So the cost of revenue is how much does it cost them to bring this in? This is going to be in marketing efforts, all that kind of stuff, manufacturing, everything, right? You also need to see that we've got a correlating trend between that top line and this line here as well, right? So 20 billion, 24 billion, 40 billion, 60 billion, 60 billion. Well, this is to month, right? So you're looking for that trajectory as well. Gross profit, you want to see that going up. And the great thing about reading accounts is that sometimes if you really, really get into this, you can really get a good understanding of what's happening in the business, what they're investing in, where their vision is. The numbers will tell you everything. The question is, do you understand what all of these numbers essentially mean? So when you're researching stocks, the financials are they are really, really important. Do you understand how to read those? So this is a great source for it. This is a really, really good source for it. The other website that helps you dissect the information, which may come in handy. Let me just get rid of this. What am I doing? Which may come in handy if you don't necessarily know how to read the account numbers. And I would suggest that it's a great skill or a great piece of knowledge, a skill set to pick up. Because once you know how to read the accounts, you become more proficient with it. You know what's going on. You'll have more confidence in the choices that you make when you're picking these stocks, right? Whereas if you use someone like Simply Wall Street, that will analyze all of the account data for you, push it out, you have to trust that they get it right, and you have to trust that they don't overlook something. And whilst that may be true because they are good, they are professionals, obviously, these are industry people who are behind that business, what you will find is that you're going to lack certain insights, because if you looked at the accounts yourself, you'll probably ask more questions than just seeing the numbers being churned out. So Yahoo Finance is great. You can use that. You can use Simply Wall Street. Those are two right there. You can also use investing.com as well. So those are three websites that can help you research stocks and the markets. But I would argue that, picking up the skill set and reading accounts and that kind of stuff, it will take some time, but it is definitely worthwhile doing, because you'll have more confidence in the things that you choose to invest in, because you've looked at the accounts yourself. And it's a learning journey as well, mate. You're going to develop that skill set, and that will pay dividends for a very long time. Ursula, let's have a look at this. Went to open a higher interest savings account, but was told it's only for 12 months. Then will be put. Let me just get rid of that. 1 second. Let's close that one down. Put into a low interest account. Um, then start saving from zero to the higher account for the next 12 months. Yeah, I mean, look, a lot of the savings accounts that are out there right now, they are um, only offering their rate for a short period of time, and then it will be put into a lower interest rate account because, from a bank's point of view, they're looking to entice you over as a potential customer. So I wouldn't necessarily let that be something that puts you off. Um, I mean, I recently did a video talking about Chip, right? So their Chip Instant Access Savings Account. That one isn't going to be put down into a low interest account after 12 months. It is an ongoing account. And that rate is now 3.05. It's no longer the highest on the market, though, but it is instant access. There's no penalties, no notice periods required. So maybe go check that account out, potentially. But like I said, I think there is one that is higher now, and I can't remember who by, but I saw it last week. It might be 3.25%. But if you type in highest instant access account, it should come up. But Chip is probably the one that I know that is doing really, really well, and they will automatically increase the interest rate on the account as and when the Bank of England base rate increases as well. So if we see another increase of 0.25% next month or in the next 2 months, you'll see that the rate on that account will also go up. And it doesn't matter whether you're already a holder of that account, you'll see that translated to the interest rate you receive as well. So maybe check that out. And what I might do is I'll put a link to that account in the comment section or description after we finish this live. You also need to find your old pensions. Any thoughts? So the two providers that I can think of here are Moneybox and PensionBee. So if you go onto the PensionBee website, they have a consolidation tool. And I believe that Moneybox still have the same. So go and check those two out because they will find all the information for you about your old pensions. And if they do exist, they can just move them into one place as well. All right, I'm just scrolling through the questions here. Gary is asking, how do I feel about the savings rates? Do you think we have seen the best or maybe more increases to come? I think we'll see more. I think we will. The sad thing is we're not going to see them um, beat the inflation rate. I don't think anytime soon. Unless we start to see inflation come down and the base rate remains high, then we might be in a territory where it will start to beat inflation. This is something that someone asked on the last live. If inflation is at 10.1% and you're only getting 3%, yes, you're losing money in real time. But the reality is, there's nothing you can do about that. So the only thing you can do is try and seek out the highest savings rate possible. I think they will go up, but they won't match inflation until we get inflation down to that 2% level. But yeah, I think we will see some increases. Samuel, Kraken, I have just seen your super chat. Thank you very much, mate. If you do have a question attached to that, I will come to you next. 1 second. Let's just get through this one. First time buyer here. I have an option to purchase using the right to buy scheme. Nice. Do you know how easy or difficult it is to transition to buy to let mortgage at a later date? Right. Okay. So if you use the buy to let, a lot of the lenders, regardless of whether or not you've bought via a right to buy or not, will not allow you to transition from a residential mortgage to a buy to let mortgage. A lot of lenders will not allow you to do that. Instead, what you will need to get is you will need to get a consent to rent. And some of the lenders will charge you a fee for that because potentially, when it comes to your mortgage agreement, you are breaking the terms of your mortgage agreement. So they won't convert it into a buy to let, but they will give you a consent to rent the property out, and that will come at a small fee, but it will still be in line. They basically adjust the mortgage agreement for you. So it is 100% possible to do that, but you just need to make sure that you're speaking to your lender as and when you get to that point. All right, let's get to Kraken. Again, thank you, mate. Thank you for the super chat. Have you stopped doing individual stock reviews as I miss them so much? Give yourself a rest, my friend. You know what? The reason why I haven't done individual stock reviews are a little, they're a little dangerous, right? So one of the things that I don't want to do is I don't necessarily want to influence people buying a particular stock. And one thing that I've realized over the 3 year, well, this is the third year, over the 2 years where I've been doing this up until now, is that it doesn't matter how many times I tell people, don't just do it because I'm looking at this and I'm the one who's talking about this. People go and do it anyway. And the reality is, when you're looking at individual stocks, there is so much work that goes into it. And how you interpret the information. So we just spoken about company accounts there, right? That's just looking at the raw data and understanding what the raw data means. Behind all of that, you then have to align it with, right, what's your goal? How long are you investing for? How much of your money do you want to allocate to this company from a risk point of view? Then if you're looking at one stock, one company as a stock, how do you then build a portfolio out that encompasses a number of sectors, right? So people will talk about the EV space all the time, and Tesla and Neo will be the two big, right? Those were the two companies that people were talking about, what, 2 years ago, right? In 21, yeah, 2021, if you talked about EVs, Neo, Tesla, and people were heavily pushing Neo, heavily pushing Neo. They're the ones who are going to beat Tesla, blah blah blah. You had Churchill Capital also, right? The guys who are building the Lucid cars. What's happened to those companies now? And the reason why I don't necessarily want to do those reviews is because I don't want anybody to be able to say, well, Pete, you did this review and I bought this stock based on your review. Then I'm the one to blame for it, because there is so much that goes into the mix of understanding. If you're going to buy the EV sector, putting all of your money into Tesla is bonkers. It's absolutely nuts. So, how do you diversify within the EV sector, right? It means you have to identify. I would start off with maybe up to 10 companies and whittle down to maybe three, four, or five that you put money into, but you allocate money to your preference of company. So Tesla might be at the top with the largest allocation, right? Allocation of cash. It might be followed by Neo. It might be followed by another company. It might be followed by another company. How do you do that? And it's hard to get those points across when you're doing individual stock reviews, because people take that information and they go, okay, this is good for me. Pete thinks it's a great idea, or there was that idea. I like what Pete said here, is going into my portfolio without any of the due care. And that's why I've stopped it, because it is really, really dangerous. And I think we've seen it with people like Meet Kev and a couple of other YouTubers who are absolutely huge, where they're changing their mind on their own individual, investment portfolios, which is right for them to do, cashing in positions. And because they're now telling people that that's what they're doing, people feel as though they've been led on. And I don't want to put myself in that kind of position. And so that's why I'm not doing individual stock reviews anymore, mate. It's just really to kind of keep myself safe, and not to be a bad influence on people. Everyone has got their own reasons for investing. Everyone's got their own risk tolerance. Everyone's got their own goals. Everyone's got their own timeline. There are a million ways that you can diversify and skin a cat, and I don't want to lean people into one way of thinking. This is all about education at the end of the day. These videos, these Q&As are, stepping stones, means for people to pick up a little bit of knowledge, do some further research. And I fear, if I'm like, this company is great, 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 here's are the cons, people will generally look at the pros and not the cons. So you're not getting a full rounded, because you have that cognitive bias. And that's why I don't do them anymore, and why I'm kind of staying a little bit clear from them. Um, that's the honest answer, mate. Yeah, someone just said here, trading economics is also very, very good for stocks, markets, and all that kind of stuff. I use trading economics for the forecasts and stuff like that as well. So yeah. What are my individual stock picks? Would I invest in uranium stocks for renewables, plate and gold mining stocks for hedge against dollar inflations? Not as individual stocks, I wouldn't. So things like gold. I will have that in one of my funds. But I would not buy individual stocks. So look, it's because of the way I invest, right? I use the core satellite approach. So most of my money is in index funds and ETFs. The individual stocks that I hold are the satellites around my core. And those companies are companies I have an interest in. So let me just give you a list of them. And again, don't go and buy these companies just because Pete holds them. Okay. So ones that I have, I've got let me just have a look. One sec. My holdings. And I've got to go through different accounts here. I've got Disney, I've got Tesla, I've got Pension B, I have got let me just go on to the other one. When it decides to load, I have got Amazon, I've got Meta, I have got Alphabet, which is Google. I have also got Microsoft. I've got a couple of others on another app. So most of mine, I've got some tech in there. Most of them are very, very big companies, though, established companies. I don't really have, I mean, I've got Canopy Growth, which is a cannabis company. Again, I researched that on the channel in 2020 after the Biden Kamala Harris victory election in the States, because they were going to be the party that were most likely to legalize marijuana in the States. That obviously hasn't happened. Those stocks have done badly ever since. Now, this is a story of stock picks going wrong, and you can never always get it right 100% of the time. But the point on this is, I only have a small proportion of my overall investment in that company specifically. So whilst that individual stock, so let me just have a look at this full transparency. So my Canopy Growth is down 91%. 91%. So in hindsight, it's a really bad investment. But at the time when I was doing the research for this, I picked 10 cannabis companies or companies that work in that area, and I whittled down to, I think it was like three that I picked. Canopy Growth has been the only one that I've held on to till now because it's done okay, but it's gone really, really badly. But the proportion of my overall investment in that company is tiny. And that's the whole point of diversification. You don't put over allocate into a company that you feel is going to be potentially risky, or one where you could get a huge amount of growth from. That's just not how it works. Certainly not for me, but that's based on my experience of working in discretionary fund managers, working with investment managers, being a financial advisor. That's my industry experience taking place there. There'll be plenty of other people who will be like, oh, I'll just sling a load of money and I'll take the big risk. That's not how I invest. I'm very, very logical in that way. And very, very, I guess I have my steps and things that I look for. And so I think for me, that pays me dividends because it means that I don't see massive peaks and troughs within my investment. That's not what I'm going for. I'm looking for a steady increase across my investments over a longer period of time. And my approach works for me. It doesn't mean that that approach is going to work for you. That's the whole point. When you're investing, you've got to find the approach that works for you, particularly if you're going to be in the business of picking your own stocks, managing your own investments. Because trust me, you really need to have balls of steel sometimes to be able to deal with this type of stuff, especially if you're in a portfolio that only has 10 stocks, and God forbid you've got it all in tech. If you have, you'll be struggling right now. Yeah. Sebastian, thank you for being here, mate. Appreciate you. Thank you very much. What are your thoughts on shared ownership, particularly when it comes to first time buyers? Look, shared ownerships, they have a role to play, mate. I know people who have used shared ownerships to get on the property ladder. I think the main consideration there is how you staircase and the potential impact you have when you come to possibly sell or exit the property, because obviously the people that you staircase with, I think they have first right of refusal. So sometimes you may not be able to get true market value for the property because, you've gone into that agreement from the outset. I would generally say, though, that if you could wait, save a larger deposit, that gives you more flexibility and more freedom in the long run. But I know that it has worked for a lot of people in the past. So it's not one to knock. I think you have to look at all of the options and then pros and con each of them. I think patience is very, very important, particularly now where we're looking at um, the lenders tightening their lending criteria around mortgages. They typically do this in inflationary periods or periods of recession. So understanding that that require that those lending requirements are going to be a little bit tighter may lead you to want to just be patient, wait, save more of a deposit, so you get more when it comes to the loan to value you offer. So if you're going in with a 5% deposit and a 95% loan to value, you're paying more in interest for sure, because the risk for the lender is way, way higher. Whereas if you're able to get enough of a deposit together where you're going in at, say, 80% loan to value, you're going to get offered better rates because the risk is lower to them. And I think that is a big, big thing right now, because the lower rates is going to translate to your monthly payments or to mortgage in terms of your affordability, and ultimately the amount of interest you pay long term. So, pros and cons, all of them, mate. They have got the save to buy scheme now. I did cover that on the channel maybe 2 weeks ago. Maybe worthwhile having a look at that scheme as well. Most of the developers are doing that now. So check that out. Pros and con it. I'm a little skeptical about save to buy purely because of the supply versus demand equation. You could get into a situation where if there's only limited number of homes or limited stock coming onto the market, people start bidding crazy, especially in London. Then all of a sudden, you're paying well over the odds anyway, and that only benefits the lenders, the developers. So yeah. Uh, Mark, let's have a look at this. Hi, Pete. Thanks for your time. I'm a first-time buyer with savings in a stocks and shares ISA at the moment. Would you recommend transferring into a cash ISA for short term rather than save an account to ensure interest not over? Yes. Personal savings allowance. Yes. Um, if you're a first-time buyer, you've got it in stocks and shares ISA. Yeah. I mean, the question here, mate, is when are you looking to buy a house? If you're looking to buy a house in the next 1 to 2 or 3 years, I would argue you need to get it out of the stocks and shares ISA, purely because you might have the market dip. And if the market dips, you lose your deposit money. It's not ideal. So put it into a cash ISA would be the right move, because it's going to be tax free regardless. And even if it does go over the personal savings allowance, like you're stating there, you'll be fine. If it's under, it doesn't really matter. I know Martin Lewis did this segment on his show where he talked about, do you really need an ISA? And there's a number of people talking about this here on YouTube at the moment. I might make a video on this specifically, but none of those people are financial advisors, have any experience as a financial advisor. And I think that's really important to take it as a with a pinch of salt, because the first rule of financial planning is tax efficiency. Okay, that's the first rule. Yes, you have a personal savings allowance. Yes, interest rates might not mean that you're going to breach the personal savings allowance, but what happens if they reduce the personal savings allowance? What happens if you see a massive hike in interest rates? Right? What happens then? So now you're in an account where you are then going to be taxable because those things have happened, whereas you could just put it into an ISA and not have to worry about that happening, period. You know? So eh, there's good information out here. There really, really is. And Martin Lewis does an amazing job in what he does, but he doesn't have a financial planning kind of like approach to what he says. He's very numbers, headline, details, and oftentimes the devil is in the detail. So I would always say to people, doesn't hurt you at all to put it in an ISA. Put it in ISA, keep it tax efficient, keep it tax free. You haven't got to worry about breaching an allowance if it gets reduced or if it gets taken away or whatever. You just have it there and it's done. And that would be my advice for you, mate. Just try and get it out if you know you're going to be needing that money for a deposit for your house in the relatively short term, 2 to 3 years. Thoughts on gold and silver as an investment? They are good diversifiers for sure. I think gold and silver did pretty well in terms of performance recently. Again, it's all about how you're going to invest in this gold and silver, right? That's the most important thing, because at the end of the day, you can go and buy index funds and ETFs to go do it. That's probably the easiest way. Some people prefer to buy physical gold, and that's fine. But where are you going to store this stuff? What if happens if you have a fire? What happens if you get burgled? So you have to think about these things. I'm just looking at the gold chart right now. Um, I mean, just look at this. Just look at this. Oh, let's get rid of that. Look at that chart. Look at this. Now, let me see if I can actually get into, you know, not bad. Actually, no, hang on a second. What am I looking at? Sorry, wrong chart. Look at this one right here. So when to this dip right here? This is so this is the 17th of Feb. So this is what, 2 days ago. I mean, just look at that. So where was it here? 18, what was that? 1828, 1851. So clearly, gold's doing okay. I mean, this is gold futures though, so gold's doing okay. So it is a good diversifier. Um, do you put a load of your money into it? That's by choice. I mean, in recessionary periods, typically people will go towards gold. Um, with war, I mean, it's not. Let's hope we don't end up having any wars with Russia or anything like that. But during conflicts as well, gold is king as well. So you'll find that countries, and Russia's certainly been buying up a shed load of gold as well. So could be a good diversifier for sure. Ooh, Marlo, this is a good question. What's your thoughts on buying a property through an auction as a first time buyer? I mean, I would assume, mate, you just the thing is, if you go via an auction, right, you're not gonna get to have any you're not gonna be able to do an independent survey of the property until you've bought it. So you could be buying something that's great. You could be buying something that potentially needs to have a lot of work done. I say that I'm not a property expert. I think if you're going to need a renovation budget, I would imagine, maybe, depending on what you're buying. If it's a repossession, then maybe not. But I think you should. I mean, it's worthwhile looking at to see if you can pick up a bargain. But I would just be aware that there could be something wrong with it, and you won't necessarily know that there's anything wrong with it until you've bought it, because potentially you're not going to be jumping through the initial hoops that a lender would make you go through, potentially, if you were buying like an existing property that isn't in auction or anything like that. So I think you just need to make sure that you kind of know all the pros and cons, and you're fully aware of what you're getting into before you do, mate. Patrick, hi Pete. I'm hoping to buy a flat next year. What's the credit score? What's the credit score impact of taking advantage of switching offers and high balance on 0% credit cards to earn interest on my normal spend before paying it off? You'll be fine, mate. It's not going to impact you negatively. If you're switching accounts, you're fine. If you're moving credit cards via balance transfer, you'll be completely fine. The important thing here, though, is, mate, like, so let's just say you don't want to have multiple credit cards open with multiple providers, ideally. All right. So as long as you're transferring the balance, so if you're transferring the balance, make sure that you're paying more than the minimum. Okay. So make sure that you do if you're transferring balance. If you're paying the minimum, then potentially from a lender's point of view, they might say, well, he's only making the minimum payments. Maybe he's under pressure financially. That could be a red flag for them. But if you're doing transfer balance and you're paying the card off, like, or you've got a structure to pay it off, then that's completely fine. If you're doing 0% credit cards and you're taking advantage of things like cashback, as long as you're clearing the balance every month, you'll be completely fine. Nothing that you said there is going to impact you negatively, as long as you're on top of it. You need to make sure that you're on top of it, and paying more than the minimum is a must. It really, really is. But if anything, if you do it right, it's going to help you boost your credit score. So when you get round to actually applying for a mortgage, you'll have a decent score, because you'll have a nice track record of repaying. Someone saying making a really good point here. U.S. inflation numbers excluding food and excluding everything key essentials for survival. And still numbers extremely high inflation. Fed is in as a passenger. Look, to be honest, mate, our numbers are exactly the same. So our inflation number came down from what 10.5% to 10.1%. What brought that down? Fuel and dining out, not your weekly shop, not energy prices. Like the energy cap is going to go up in April. So that's going to be the next market that people are going to look for. You know, how is the energy price cap increase in April going to in fact impact our inflation number? That's the next thing to watch for, really, to be honest. So yeah, it's the inflation numbers, when you look at it and you look at the in-depth numbers, a lot of it doesn't make any sense, and that's where we're relying on the central banks and the guys who are very, very clever to really do what is necessary, and hopefully bring the numbers down. There's a lot that needs to go right for those numbers to come down, and look, we've got to trust that they understand and they know what they're doing. um, a lot of people don't have confidence though. Um, and trust me, I do not blame people for not having confidence as well. 100%. Right. I just want to say thank you to whoever it was that just purchased my book. Was it Sebastian? Was it you, Sebastian? Please let me know, mate. I appreciate you. Um, the book is out in like on March 16th, effectively. And yeah, it's a little surreal, to be honest. It's very, very surreal to think that, I'm going to have a book that's going to be coming out. But let me just show you the cover of the book for those people who may not know that this is actually coming out. So the book is called The Money Basics: How to Become Your Own Financial Hero. So what I've done with this book is I built a formula. So it's a 5-step formula for financial security. Now, we do talk about investing in there, because investing is one of the principles, okay? But it is very much sequential. And I've actually used this basic formula in my personal finances for the last 7 years at least. And it's got me to the point where I am financially stable, I'm financially secure. And I know that it works, and I put everything into that formula, um, because I think the knowledge that I have and how it's worked for me practically can be replicated if you adhere to those principles and that 5-step principle. Um, I can't wait for it to come out. It's also an audio book as well. But thank you so much. I think it's you, Sebastian, who bought that. And if you want to order it, it is available on Amazon right now on pre-order. We are going for a Sunday Times bestseller if we can. It's a big, 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 big goal. But look, if you don't dream big, you don't you don't you don't you don't achieve anything, right? So that's where we are at the moment. Right. Let me just see where I was. I'm really conscious there are a ton of comments. I will try to get to them, and we're already over time. I'm just trying to find where I was and see if I can just speed through some of these. Okay, I've already done that one. Oh, thanks, Ad. I appreciate that, mate. Thank you very much. Really do. Thank you. Al, what platform is best for upcoming new tax year? Um, Stocks and shares, ISA, not just ETF. Oh, are you? So I'm guessing you're asking investment platform, right? Wait, there are lots of them, mate. I mean, most of them will offer ISAs anyway. Um, not just ETFs, not just ETFs. Well, you got index funds and I mean, the main vehicles that a lot of these companies use to invest are ETFs and index funds. So if you want one that give you index funds, give you ETFs, and gives you the ability to invest in individual stocks, then Trading 212 is probably the top of my list right now. Followed by someone like maybe Free Trade, because you can access ETFs, index funds there, and individual stocks. eToro, you can do the same with eToro. Vanguard is only going to give you index funds and ETFs. So Vanguard, Invest Engine. You can't buy individual stocks on Invest Engine. So there's a few there, mate, and all of them will have ISA availability as well. Um, The only one that you need to pay for the ISA account is with free trade. I think they charge like $3.99 a month or something like that for their ISA account. But it's 36 quid a year. Let's have a look. Okay, what are your thoughts on Moneybox and tips where you would rank Moneybox? Moneybox is really, really good. Moneybox, I like Moneybox because of the roundup feature. The roundup feature is awesome. If you're in that place where you want to begin investing, you haven't got a massive lump sum, and you just want to get into the habit, then the roundup feature is amazing because you can spend 10 quid at a Tesco's or 9.95 at a Tesco's. That 5p will be rounded into an investment for you. Fantastic for that. They are a little pricey. I think for the amount that you pay them, you would get a better service from the likes of maybe Wealthify and Money Farm. Because with Money Farm, for example, it's active management. You can actually phone someone, actually speak to somebody about your investments. You're not going to have that with Moneybox necessarily. And with Wealthify, they're just great, and the team is just awesome. They are so good. You can pick up the phone, you can speak to them. They're just an awesome team. So I think you will get better value using one of those two. But Money Farm doesn't have the roundup feature. Neither does Wealthify, to my knowledge. So if you're just starting out, you just want to start investing small little bits as you go along. Moneybox is top for that. But in terms of like service and other things, I think Money Farm and Wealthify will rank higher. I'd put them third. But it swings and roundabouts. Have a look at all three, mate, and just see which one would work you like the look of. And also, one thing you do have to remember here is do need to check out the app, because you're going to be interfacing with the app every single day, right? So you want to make sure that you like the interface and you're able to use it, because if you can't, it kind of defeats the purpose if you don't like it. Elroy, I'm new to your channel and understanding ISA accounts. What's the difference between platforms and stocks and shares ISA, and thoughts of lifetime ISA accounts? Okay. What's the difference between platforms? Right. So your platforms are the companies that you will use. So I've mentioned a few here. You've got there are lots of them, mate, and each of them do different things. So you've got Vanguard. You've got let me just try and categorize them for you, for people who do similar things. So if you don't want to have to do anything yourself, you just want to send somebody money, then these following platforms will be of the same ilk: Money Farm, Wealthify, Nutmeg, Moneybox, um, Plum. So those are five. You can just send them money, they'll do it for you. You don't have to worry at all, right? But you're paying these guys more money. Now, if you wanted to have a little bit of ownership of your own, because you think that you can pick, index funds or ETFs, you've got enough knowledge to be able to do it, then the following are kind of in the same basket. So you're going to have Vanguard, Invest Engine, Hargreaves Lansdown. I would throw AJ Bell in there, but they're very expensive. So I'll go with those three because they're relatively cheap. So Vanguard, Hargreaves Lansdown, Invest Engine. Okay, so those are platforms. Those are companies that you would use to invest. Now, your stocks and shares ISA. Your stocks and shares ISA is an investment ISA where you can invest £20,000 every single tax year. The tax year runs from April the 6th to April the 5th each year. So this current tax year is going to end April the 5th, 2023. The new tax year is going to start April the 6th, 2023, and will run to April the 5th, 2024. So that's your tax year. Within that period of time, you can put £20,000 into a stocks and shares ISA. Now, your lifetime ISA is another type of ISA, but your allowance for that is £4,000, and that is inclusive of the £20,000 you have, right? So in stocks and shares ISA, you can save £20,000, but £4,000 of that you would allocate to your lifetime ISA. Now, your lifetime ISA can only be used for two purposes. Number one, if you want to buy your first home, and number two, if you want to save for retirement. There are some restrictions, some limitations around lifetime ISAs in that regard. But essentially, if you put £4,000 in every single tax year, the government is going to give you £1,000 either towards your first house as a deposit, or towards your retirement planning. And that money will be paid to you. You need to have the money in the account for 12 months in order to get the 25% free from the government. That's just a very, very high level overview. I have made a number of videos on the channel that will go into a bit more in-depth explanation of how they basically work. But that's just a very, very high level um, explanation. So I hope that helps, mate. What I might do is if I can find some of the videos, if you actually, let me just signpost you right now. 1 second, mate. Which ones have I done about ISIS? I can give you a couple just to go and have a look at, to videos to watch that would be useful. And if I can grab the link, I'll put it in the chat as well, so you can actually see. Like, this may take me a minute. There are a lot of videos on this channel, so I need to find the most relevant one. Actually, can I search? I thought I could search. And I can search my content. 1 second. Content. Okay. ISA. Uh-huh. Uh-huh. Okay. So I would probably recommend that you go and have a look at this video right here. Okay. So even though this says the 2022-2023 tax year, it will still be applicable for the coming tax year. So this is your allowance. It's 5 ISAs FAQ. So what I'm going to do is I'll just copy this link right here, and I will put this in the chat for you right there. I'll actually pin it as well. So it's pinned at the top. Go and watch that video, mate, because that will answer a lot of your questions. And you should be signposted to other videos that I've done on ISIS from there as well. Well, let me just find where I was. Right, there's a handful of comments just to go. I'm well over at the minute. So I'm just going to try and get through these, and then we'll call it a night. I haven't looked at Lightyear. I've already covered a lot of platforms already on here. Which one is best for you will be dependent on how you want to invest and how you choose, really. Because this is the thing that people need to understand. If you're picking individual stocks, that's one way to invest. If you want to invest and have a hybrid approach, and by the way, again, shameless plug, but it is definitely worthwhile plugging this. I talk about the 3 ways on how you can actually begin to invest safely in this book. So you're either a DIY investor or you want to take a hybrid approach, and there are 2 ways that you can do that under your hybrid approach, or you can just give it to someone to do for you, which I've already explained a little bit earlier on. But the best platform is going to be subjective according to how you want to invest. Whether you want to have control, whether you want to have semi-control, whether you just want to hand it off to somebody. But I've heard of Lightyear, but I've not done a review on Lightyear just yet. I don't know. I haven't done a provider review for some time. If I get enough requests for it, I will do it. But yeah, reviews are great, but it's a little boring doing reviews sometimes, to be honest. But I don't know. We'll see. Matt, does moving an ISA to another provider mean you're moving the shares, or will you have to liquidate your equities? Right. So when you're doing an ISA transfer, the providers do all of that for you. It is very, very rare, in my knowledge, that you'll be able to move your money from Moneybox to, I don't know, to another company, for example, without liquidating the shares, because it has to move from one provider to another. And so, for example, if Moneybox have got it invested in a particular way, you move it to a company over here, they may not have an identical way of investing that money. You will select something separate that looks or feels the same. And to do that, it has to be liquidated. But they will do pardon me. They will do all of that for you. So you don't have to worry at all. But the key thing to remember is when you do the transfer, let's say you're going from Moneybox to, I don't know, Wealthify, right? You have to ask Wealthify to instigate the transfer for you. Don't close it and transfer the money over. You're opening the gate to a whole host of issues, particularly if you've done your ISAs year on year. You've got quite a bit of money in there. There's lots of issues that come with that. So ask Wealthify or whoever it is you want to transfer to instigate the transfer, and they will do all of that in specie. In specie means that it doesn't change wrappers. It's exactly the same as it should be, barring the investment proposition. But the wrapper, the account, it's pretty much the same. All right. Okay. Okay. Ooh, okay. There's a few more to get through. Uh, oh, this is interesting. I've just opened a Nutmeg stocks and shares account, which my Chase account is now offering. Interesting. I was looking at Chase actually because they've got a really good cashback offer, and I was thinking of doing a video on them. Um, hmm, they've got a tie with Nutmeg. That doesn't surprise me actually because JP Morgan has Nutmeg have a JP Morgan offering, so there'll probably be an existing relationship there as well. Um, why are stocks more expensive on the New York Stock Exchange? An example: GSK is £14 on the London Stock Exchange, but its currency is, but it's currently $35. It just doesn't make any sense. Well, if you're buying on the New York Stock Exchange, mate, you're buying in dollars, so you got the exchange rate. So that will be another factor that will go into it, mate. So obviously, with now, what we're not getting as much for the pound as you would do previously. You part of that difference will be the currency conversion. Now, why else? I've already answered this one. One sec. Where are we going? Pashal. Hi, Pete. Please, do you know how one can move their company share save in stocks acquired from their company and employer and move the stocks and shares to a stocks and shares ISA after 3 years? You would have to liquidate, mate, because I don't know a share save that will allow you to transfer to an external investment wrapper without you selling down. You would have to sell it down, as far as I'm aware, unfortunately, mate. So yeah, I don't know of any way you can do a transfer where you keep it in specie. Unfortunately, you'd have to sell it down. Emmanuel's actually made a really good point here on the auction question. You got to remember, especially if the property is not in a good state of repair, they generally don't like it because you've got to think about it, right? You're taking out a mortgage for this property. The property is collateral. It's the bank security. If you fail to pay, they will take back the home and try and recover their money there. If via auction there's something wrong with it, you're going to struggle to get a mortgage. You'll probably get a mortgage if you've done the repairs, then they'll be fine. But you'll need to be certified and stuff. But generally speaking, Emmanuel's right. They typically won't like you getting a house on an auction. So you need to think about that really carefully. Panda, how you doing? Just wanted to ask, what is the best way to make money online? Ah, look, this is a really good topic. If you ask me, I can only talk about the things that I know, um, because on this channel I've had people talk about Amazon FBA, and people have made some very good money doing Amazon FBA. I've had a lot of people make money doing drop shipping as well, which is kind of an extension of Amazon FBA, but it's slightly different, right? I have people who have actually gone onto things like Fiverr, or there was another one as well. What's the other one called? I can't remember what it's called now. Places like Fiverr where you can basically put up your skill set. So if you're good at, I don't know, video editing, photography, whatever, people will then hire you, editing, that kind of stuff. I use a guy from Fiverr on occasion to edit some of my reels. So people will use different sites for different things. I My business is online. Okay. So well, I left a very well paying corporate job to do this in 2020. And I've managed to build my business now online to the point where it is self-sustaining to a certain extent. I still need to be here, but I'm making good money online, and everything stemmed from YouTube, but it's not solely all about YouTube. And so, what I generally say to people when they ask me this question about how to make money online, I strongly encourage people to think about something that they either have an interest in, they're passionate about, or they feel compelled by, and go with that. Because making money online, and if you're, buying things on eBay and just flipping them, yeah, you can make good money doing that, no problem at all. If you want to do Amazon FBA, yes, you can make money doing that. If you want to go on Fiverr, yes, you can make money doing that, right? You can do surveys online. That's very, very time consuming for very little pay sometimes for a lot of people. But I think if you do something that you're more compelled with, that you're passionate about, that you have an interest in, it sometimes doesn't feel like work, although it is. Don't mistake it, but it feels more rewarding doing something that you're interested in. And I can definitely say that is true for my journey here. So if you want to make money online, look, I think the important thing to recognize is that it's not a quick win. It will take time. I didn't make any money online the first year of doing YouTube. I only started making money in 2021. Luckily now my business has changed to the point where I don't make a lot of money on AdSense. Like these sessions here, I make no money from them at all. I'll put ads on this video after this has gone live tomorrow, and I'll probably earn £4 or £5 for the last hour and 20 minutes that I've spent on here. I've had a super chat this evening for £5. YouTube is going to take half of that, so that's £2.50. So if I look at this video specifically, I will probably only earn £7 max for an hour and 21 minutes work right now. It's not a quick win. And so I think it's really, really important to go into it with that in mind. However, with what I do now, it obviously has translated into other things. So it's translated into me doing a little bit of TV. That is paid work. So I know I've got that money coming in every single month. It translates into me doing coaching ever so often when I have the time to do coaching. And I now have people who are almost on a waiting list for coaching and mentoring services, right? So that's there. My book is going to be coming out. So I made money from the book, from signing a book deal. I'll also get royalties from the book. So that will be an income stream moving forward. I have my course. I don't push my investment course anywhere near as much as I should. But that in itself last year probably made me around about £10,000 that I wouldn't have had if I didn't make that course in the first place. I now do speaking engagements. So I charge if I do any speaking engagements for companies, right? And I have a ton of those already lined up this year. So what I'm trying to say here is that if you do something that you have an intrinsic interest in and you have a skill set or a knowledge base in, and you can speak about it passionately, there is no limit to where it can basically go. I sometimes do work with brands, for example. So I only did one last year with who did I do it with last year? With Wealthify. I did a brand deal with Wealthify last year. That's the one that I did. I've done one this year so far. I might do another. I'm not too sure just yet. So that is an additional stream of income. The point is, if you're good at what you do and you're passionate about what you want to go into, the sky really is the limit. If you can give it enough time, you can persevere. And trust me, you're gonna have to persevere. The amount of times that I kind of want to give this up, I'm not gonna lie, because the channel, as it grows, it has grown very, very slowly over the last 12 months. And there is nothing more demoralizing than when because a lot of the videos, you got to research it, you got to script it, you got to film it, you got to edit it. I do all of that on my own. And when you put a video up sometimes and, you don't get the amount of views that you would hope that you would get, because let's be frank, the way YouTubers make money is by views on their video. So if you look at some of the bigger investment accounts where they're getting, 15,000, 10,000 views regularly, those guys are bringing in anywhere between £3,000 and £5,000 a month. I'm not getting anywhere near that much with the level of views that I get. And I could get that level of views if I tweaked my content strategy slightly and did things that were a bit more clickbaity, a little bit more controversial. I could make that kind of money, but that's not me. My approach is this stuff is boring, and it's intentionally boring because if you're serious about it, you're here and you want sound advice that is level-headed, that isn't full of hyperbole. That's my thing, right? And that's what's got me to do the TV and all this kind of stuff now. So that's my brand, and I would like to think that people who listen to me would think that I'm trustworthy and trust what I have to say. And it's not because I'm being paid to say something; it's because I know that it's right. And so that's really, really important. But if you can just tune into that one thing and you can give it the time that it needs, believe me, where it can take you is amazing. And this channel is a prime example of that. And so, I would encourage you, think about something you're passionate about, think about something that you have an interest in, something that you have a knowledge base in, something that you're good at, and try and go with that, because you're more likely to build something out of it that will be long lasting than just going into a drop shipping or an Amazon FBA or a Fiverr kind of gig where, yeah, you'll make a little bit of money, but you're not really building towards anything. It's a long-winded answer, but it's a really important message that I want to get across. You know, online, the opportunity here is huge. It's absolutely huge. It really, really is. All right. There are. I'm going to get through one more question after this, and I'm going to clock off. Is it a good idea not to have much cash savings? I have a reliable job, and I put half of my salary in stocks and shares ISA monthly for 20K and remaining into a SIP. Only have around £200 left over monthly. Look, so I talk about this in my book. So if you think about financial security, the idea of financial security, one of the key components towards that is actually having an emergency fund. Now you can go put money into a stock and shares ISA on a monthly basis. You can go and put money into a SIP, but the first issue that you have is the money in your SIP is locked away until you're age 55. That's not a bad thing. It's just one of those considerations that you need to bear in mind. Now, your money in stocks and shares ISA, yes, you could access that if you wanted to. However, if the markets crash, do you really want to be taking money out of an investment that is falling in value? And so, one of the first things that you need to bear in mind when you're investing is, do you have an adequate emergency fund? And the emergency fund is there to basically tie you over so you don't have to use things like credit cards, overdrafts, payday loans, or God forbid anything else that costs you tons of money in terms of interest. Your emergency fund is your safety net. Now, most people would generally recommend, especially when I was advising as a financial advisor, because I'm a qualified financial advisor, would advise that you have an emergency fund which equals either 3 months, 6 months, 9 months of your expenses. So the things that you have to pay for, that will be your rent, your electric, your mortgage, your food, anything that is committed expenditure. So that will include things like car finance, credit card payments, all of it. So you tally all of that up, you times it by 3, 6, 9. That should be your emergency fund. And the whole idea behind that is, even though you say you feel that you've got a reliable job, what happens if you are unable to work for health issues or you get into an accident and you can't go back to work long term and you don't have an income protection plan? How are you going to pay your bills? Yes, you could go and cash in the investment, but again, if it's down, probably not something that you actually want to do. This is where your emergency fund then comes in. So you call in your emergency fund as that tool that you use to cover yourself, leaving your stocks and shares ISA to the very, very last point to access. So an emergency fund is really, really important. Now, I actually share this in the book as well, and I don't want to give too much away on the book, but I share a lot of my own personal experiences and the reasons why the principles, the basic formula that I built for the book is relevant. I share my experiences of them. So I was just talking about YouTube and what I do here. This right here would not be possible if I didn't have an emergency fund in 2020. If I'd invested all the money that I had lying around in 2020, this would not be happening. I wouldn't be here speaking to you today. None of this would have happened because I would have had my money locked in an investment that I probably would have been too stubborn to access because markets were volatile. And so it's really, really important. Most people will argue, well, interest rates are really, really bad. And if I put money, an emergency fund into an account that isn't bearing interest, then I'm losing money. Yeah, that is true. But at the end of the day, what you need to think about here is that you're looking for security. Okay. You're looking for security. So if I were to put this in the analogy of a cake, right? You want the cake, not the cherry on top of the cake. A lot of people put the interest as being the most important thing. If you can get a decent rate of interest, that's the cherry on top of the cake. It is not the cake. So you want to make sure you're secure. So I would strongly encourage you, if you need to build an emergency fund. You really, really, really do. And it's gonna give you so much peace of mind knowing that doesn't matter what happens, you're going to be sweet. You're going to be fine. Just knowing that the money is there that you can access at any given time. Trust me, you feel a completely different way. So, again, a long winded answer, but these answers do require a little bit of context sometimes. And, what it does for you psychologically is absolutely huge. It really, really is. It just puts you in a completely different space where you haven't got to worry about credit cards and all this kind of stuff. I have zero debt. I don't have any car finance. I don't have any credit cards, any personal loans. I don't have anything. I've got a small mortgage on this house right here. That's it. So from my point of view, I could, if I wanted to, I could just go. I could be offered like 2-3 months. Wouldn't have to worry at all. I've got enough in an emergency fund. I would not have to worry at all. I've got enough in an emergency fund that will probably last me for a year. I could go traveling for a year if I wanted to. I'm a workaholic. I'd never do that. But it puts you in a completely different state of mind, knowing that you have that security around, and it takes the pressure off. It really, really does. Right, one more. Let's have a look at Warren. Oh, PW. You just put a question in I've just read, and I'm like, okay. All right, okay, cool. Right, let me do this one. I'm going to get to the last one. Property. I'm looking for property I'm looking for does not have a EWS1. Agent mentioned that it would be possible to get the mortgage for this property. What's the risk of buying a property which have not completed the EWS1 process? I'm not familiar with that process. I've not done a mortgage. I've not advised on a mortgage for probably 3-4 years now, mate. So I'm not really too sure what an EWS1 is. What I would say though is if it's a requirement for the mortgage, you are going to need one, and it will impact your ability to get a mortgage. Some of the lenders, if you tell them up front, may say, okay, we'll agree a mortgage pending it coming through. But if it is typically a requirement for the mortgage, then you have to make sure that the property has it. That is the truth about it, mate. But again, what I would say is if you're probably speaking to a mortgage broker, have a conversation with the mortgage broker, and you need to make sure that number one, the mortgage broker is a whole of market, not a restricted advisor. Because if he's whole of market, when he starts sourcing mortgages for you, he will put this in some of the information to whittle down providers where if this is an issue, you won't get offered from them. And if you do need someone that, this might take a while and you need it to be approved without it, he might then have a list of providers that would accept it without an EWS1. But I think you need to speak to a mortgage advisor and you need to speak to the lenders, really, to be honest, mate, because if it's something that they require for the property, they might just say, look, we will agree it in principle, but we won't complete on the mortgage until you have it. So you need to keep the lines of communication open, mate. 1 second. Let's have a look at this. Grenfell listen, mate, listen. So you've just explained what it is there. You will definitely need one. They will not write a mortgage if they don't have the fire safety. It will just be too risky for them, mate. They just won't. So you need to make sure that they have one. Again, if you're speaking to the mortgage lender, to the mortgage broker, you might want to put that in his search criteria. But I'll tell you right now, if it is to do with the Grenfell Towers and it's the fire safety protocols, you'll be very, very hard pushed to get a mortgage that will overlook that potentially, because you're putting the collateral at risk potentially. How do you feel about the Global All Cap Fund? The Global All Cap Fund is pretty good in Vanguard. I know that's a Vanguard one. I think that's a VWRL. Could be wrong. But it's globally diversified, so it's pretty cool. Right, this is the last question, PW. What's the difference between a SIP and Nest pension scheme? So, right, okay, look. Your Nest pension is typically something that you will use if you are auto-enrolled at work. So you could be in a workplace working for a company and they put you into a Nest as part of their auto-enrollment. Nest is kind of like the government bog standard pension scheme, essentially, that they've made available to employers when they bought in auto enrollment back in 2014. It's okay. The choices are a little bit slim. If you are in a nest, I would encourage you right now, you probably need to go and have a look at what fund you're invested in, because you're going to their default fund and their default fund is a little basically. So make sure you go and look at that. Now, a SIP is a self-invested personal pension. So that's where you have control over what you invest in. A SIP, people confuse SIPs and personal pensions. They are separate, but they are kind of the same thing. A personal pension. Now, you would normally use a SIP. SIPs are great for business owners where they, for example, they've got an office block, they own the office block and they want to put that office block into a personal pension. I would argue that if you're a normal person, a personal pension will do fine. You can get a personal pension from Pension Bee, from Moneybox, from Wealthify, from Money Farm. Most of the investment platforms will have personal pensions. You can get it from Hargreaves Lansdowne as well. You can get it from Vanguard too, right? Most of them have them. Some of them will call them SIPs. Some of them will call them personal pensions. Uh, it's the same thing. But if you're talking about a true SIP is used to put commercial property and other assets that you can't put in a traditional personal pension. So it is for a set kind of person, company owners, that kind of thing. They are typically more expensive with those kind of functionalities. But if you want to weigh up personal pension SIP against your Nest, you need to be a little bit careful, because if you're also enrolled in your workplace, you don't necessarily want to be diverting money into a SIP when you could be getting more free money from your employer going into a Nest pension. So read up on both. If you're asking because it is a workplace thing, speak to your employer as well. You need to go and have a look at the Nest pension scheme, see what fund you're invested in, and see if you can actually move it into something else. But yeah, I mean, look at the SIP or the personal pension as your last resort. I would probably say if it's because you're in a workplace, pay money into the SIP, particularly if your employer will match your contribution. So at the moment, if you are an employee working for an employer, your employer will pay in 3%, you're paying 5%. That's 8%. But some employers will say, well, if you pay in 10%, we'll also pay in 10%. It's extra money for free. So I would be looking at that option first before you start investing in a SIP or a personal pension, because you don't want to say goodbye to free money. All right. There is another person who's actually bought the book. Thank you very much. I do appreciate you. Right, that's an hour 37 minutes. I said it was going to be 45 minutes. I appreciate you guys. Thank you so much for joining me. And I will see you on the next one. I don't know when it's going to be. I will have a video coming out tomorrow, which is a conversation from the podcast. It's very, very interesting. So if you are around tomorrow afternoon at 12 noon, the video will go live. It's very, very interesting. We're talking more about money and mindset, money and psychology, why we make the decisions that we do when it comes to our relationship with money and our purchasing decisions. It's a very, very interesting conversation. It's on the podcast. It will be on at 6 a.m. So you can pick that up at Spotify, but the video will be on this channel from 12 noon. Appreciate you. I'm going to have an early night because I've got to get on an early train into London.